Hi, my name is Mu-Hsuan, and this is my audience, Joanne,
Hi.
Sharon,
Hi.
and Audrey.
Hi.
Okay, so today I'm going to talk about the subprime mortgage crisis. In this topic, we are going to examine the origin of the crisis and its impact, and to propose a series of possible steps that we all can do to protect ourselves from the current and future crisis. In 2008, the United States and the world economy faced its most dangerous and devastating crisis since the Great Depression of the 1930s. This so-called subprime mortgage crisis, which began in 2007, when high home prices in the United States finally turned downward, spread quickly throughout the United States financial system. Interest rate began to rise and housing prices started to drop in many parts of the United States. As a result, the foreclosure and default rates on subprime mortgage loans began to increase as borrowers were unable to afford their payments based on rising interest rates. Banks began to lose money, and they started to write off these bad loans in their balance sheet. To help you guys understand the scope and magnitude of the crisis, here are some of the historical facts. Since the real estate peak, U.S. home values have fallen by $6.3 trillion. Nearly 9.2% of all U.S. mortgage outstandings were either delinquent or in foreclosure. Last year, over 400 U.S. financial institutions bankrupt, which with an estimate loss of $12.4 trillion. That's a lot of money. In preparing this report, data collection will start with secondary research, including a review of most recent published articles and studies on the subprime mortgage loans and its effect on the financial crisis. Primary research will also be conducted, and they will focus on historical data and government investigations. So to fully understand the crisis, we have to first examine the origin of the subprime mortgage crisis. The origin of the subprime mortgage crisis could be traced back to the U.S. housing bubble beginning in early 2001 and reached its peak in late 2005. During the housing bubble, home buyers think that a home that they consider too expensive for them is now an acceptable purchase because they will be compensated by future price increase. Many of them also believe that if they don't buy the house now, they will not be able to afford it later. These notions are not true because the housing prices cannot go up forever. This is the picture of the inflated adjustable home price. As you can see, on July 2006, the home prices reached its peak at 200% increase in its value, and after that, it fell dramatically down to 140%. After burst of the housing bubble, interest rate began to rise and housing prices started to drop in many parts of the United States. As a result, the default rates on subprime mortgage loans began to increase as the borrowers were unable to afford the payments based on the rising interest rate. This is the Standard & Poor's reports on U.S. National Home Price Index. And right here you can see in 2008, average U.S. home owners lost about 20% of its value of its house value. So clearly, we can see that the subprime mortgage crisis create negative impact on homeowners as well as on financial institutions. So the subprime mortgage crisis have a devastating impact on homeowners and on financial institutions. As home price continued to fall, homeowners were forced into foreclosure, and financial institutions began to lose money on its subprime mortgage loans. For homeowners, thousands of them were forced into foreclosure. Nationally, the number of foreclosure homes had risen more than 20% from the first half of 2007 to the end of 2008. Homeless rates were rising as well. Many banks, mortgage lenders, hedge funds, and other financial institutions, they suffer significant losses as a result of the crisis. According to the New York Times, as of August 2009, financial institutions around the globe have written down their holdings of subprime mortgage-related security by $1.4 trillion. These losses caused a massive reduction in bank capital. So after the crisis, several solutions are developed by the financial institution to reduce losses and to prevent future crises. So financial institutions are now investigating a reliable method of loan origination, reducing foreclosure through negotiation, and reducing subprime mortgage loans and mortgage-backed security on the balance sheet. And finally, they work with policymakers and credit agency to ensure their products are made with the government compliance. So what do these solutions mean to us as a homeowner? This means that excuse me. This means that homeowners will be more educated and more informed by financial institutions when purchasing their property, and are less likely to lose money on mortgage fraud. Well, many of you guys may ask, what can we as a homeowner do to protect ourselves from future crises, future mortgage crisis like the 2008? Before purchasing well, this is easy. Just follow the 3 steps that's written here. Before purchasing the house, you need to establish your good credit score and access your affordability. You will never buy a house that you cannot afford. After purchasing the house, make sure you make your monthly payments on time to avoid penalty fees and rise interest rate on your mortgage. So this is my presentation on the subprime mortgage crisis. Is there any questions?
Yes.
Yes, sure.
How interest rate affect the mortgage payment?
Well, interest rate have a direct impact on the mortgage, the actual mortgage payment. For instance, if the interest rate go up 1%, you will have to pay 1% more on your monthly mortgage payments. Sometimes this is enough to push homeowners over the edge and force them into foreclosure. Okay? So is there any question?
Yeah.
Yes, Audrey?
What can we do if we are unable to pay for our mortgage payment?
Well, the only thing I recommend you to do is to ask for help. Lenders and homeowners both will benefit from avoiding foreclosure because foreclosure is a costly process for homeowners and for banks as well. Its financial institutions are very happy to help you and assist you and provide you with more favorable mortgage terms. So talk to your bank and see if there's anything that it can help you. Okay, is there any questions? Okay, thank you.